It's no longer just about access to markets anymore. It only takes one bad tick to really disrupt a business. Having the credibility and the trust that you know that when you need to hedge, that facility is there for you. You need to advance your systems and adapt, because if you're just offering a price feed, your business is going to dry out pretty quickly.
Hi everyone, welcome to another episode of FinanceFeeds Podcast. If you like our content, don't forget to like, subscribe, and comment on our videos. Today, we're continuing the discussion about institutional FX and liquidity. Joining me today is Liam Smith, who's Chief Operating Officer in the UK for 26 Degrees Global Markets. Liam, thanks for taking the time out of your busy schedule. We're both very busy. It's IFX week here in Cyprus.
Yes.
Thanks for taking the time to join us.
Thanks for having me, Nikolai, and FinanceFeeds. I'm excited to be here. And yes, it has been quite a week, but this is a great way to wrap it up.
I agree. I think today we're going to discuss some really, important topics, because I think they echo what's going on in the financial markets today and what has been happening in the financial markets probably for the last year and a half. I've interviewed your colleagues here on the podcast previously, and I think our discussion here will be a good sort of refresher, but also some new stuff to talk about institutional liquidity. And I wanted to start off by saying that I think that over the years, institutional trading firms have competed on primarily, let's say, on access to liquidity, right? Like, we can give you pricing, we can give you a price feed, we can give you, everybody always says, we can give you very tight spreads, and things like that. To me, it seems like over the years, this has all been so sort of commoditized. Again, you come to an LP, you start talking to them, and again, I would, correct me if I'm wrong, but these are the key talking points that you often hear. But in looking at what's been happening in the financial markets recently, it seems like the real competitive edge for institutional firms has shifted towards what I would call liquidity intelligence, which is, understanding your price flows, understanding who is trading on your book, right, as you would call it in your line of work, and kind of, what's going on with my trades, with my pricing and things like that.
Yeah, absolutely. It's no longer just about access to markets anymore. I think anyone, even retail traders, can go and get a price feed via API, have updates, see really tight prices. But that's not really what the liquidity is about anymore. It is the edge of it. And it is, for a retail broker especially, it's making sure that your provider is, yes, giving you the tight spreads that you need to compete and to gain market share, but it's about sustainability. You don't want to be running a liquidity desk or a dealing desk where you're constantly having to shift flows between providers and the disruption that comes with that for the clients. And I think over the last 12, 18 months, we've seen a big shift of traditional retail brokers, their cost of acquisition increasing, and they've sort of looking to diversify or expand their client inflow. And so for that, they look at the B2B section or the wholesale section and think, oh, that's easy. There's not big marketing budgets required necessarily. And so they spin up a institutional arm and start offering liquidity and become a liquidity provider. But that, I think, for many, they underestimate heavily what's actually required to deliver an institutional grade feed. And it's not just the pricing. This day and age, flow profiles change so much. Brokers will send a whole array of flow profile down a single feed. So you need to have the intelligence to be able to route that flow, to be able to segment, and to be able to do so on a sustainable feed that will survive with your business.
And what has changed structurally, let's say, in markets that made execution intelligence materially more important than, let's say, it was 5 years ago?
Yeah, I think the shift has been the knowledge of the end flow and how educated it is, and the fact that the access, sort of what I just mentioned, the access to different price feeds has become so much easier, even for the end retail clients that are using these EAs and these algorithms, and especially now with the vibe coding tools or the AI coding tools. Any person that opens an account with a retail broker can actually have quite advanced strategies. So when they're executing that, they need to be or the brokers themselves need to be able to handle quite advanced flow.
Yeah.
And so from that, I think comes with the tools required to do that. And also the technology vendors have been producing some really fantastic tools and empowering everyone in the industry. So it's no longer just any price, hitting the price and that's it. It's all about the post-trade or what happens to that tag and that flow profile over a long time, and the sustainability aspect, I think.
I've heard a lot about or keywords like pre-trade, post-trade. It seems like, again, firms are focusing a lot on, I think you said, in a way, their bottom line, right? Because things are, acquisition costs are increasing and things like that. And then you really want to know if you're using an LP, what are you getting? And are there any opportunities in there, or are there any things that could be improved, right? I think if we look at, again, the markets today and the markets in the last year or so and the volatility spikes and things like that, I think that's the perfect time for companies to kind of understand, okay, well, what's going on? Am I missing the low-hanging fruit, so to say?
Yeah, definitely. And you said something there that a key word, it's what am I getting, and also what am I not getting? And that might sound strange, but one of the compliments that we get from the larger brokers that are quite switched on and their dealing desks have had experience with many different liquidity feeds, is compliment that we get is the actual stability in the quotes. So it's not just the tight spread, it's when the markets move. It can, during the times of volatility is when you can be quite exposed to off-market quotes. And it only takes one bad tick to really disrupt a business, unduly trigger like stop loss orders, or trigger resting orders. And that can be really detrimental for a retail broker. A single quote can cause severe damage to their reputation. Their support teams might take days for answering queries, the dealing desk trying to unwind trades. And even if you're able to do that all successfully, the reputational damage is really bad, can be really, really long lasting and can kill your momentum as a growing broker. So for us, we have been refining quote filters, adding quote filters over the last 14 years. So it's our feed, it's what you're getting the great pricing and the stable quotes, but also you can trust that you're not getting bad ticks, you're not getting bad fills that are going to cause a lot of disruption to your business. And then the second thing that I would say is also, because of the recent volatility events, especially those around January and the huge asset rally that we saw, which I think for many brokers was unexpected, how one directional and how long it would continue. The thing that is underestimated with providers, liquidity providers, is the credibility and stability of the feeds. So what I mean, or not so much the feed, sorry, of the facility. So when you do want to hedge, January saw towards the end of the month or during the month, a lot of brokers held on to the risk. They thought they could ride it all the way. Towards the end of the month, many wanted to hedge. And by that point, we found that a lot of them were going to their liquidity providers, and the facilities they thought were there in terms of NOP limits and conditions were not actually. And so there was a lot of primes out there, a lot of new entrants to the prime space that had to compete on commercials or risk conditions, which can be very dangerous. And so they were writing really big risk limits to small counterparties. And at the time when those counterparties and retail brokers needed it, they'd stretched out too far. They'd given out too many multiples of what they had available, and they were forced to pull the rug out from under brokers. So in summary, it's what we don't send. It's the quote filtration and all of these other hidden things, and that's far less exciting topic. But like server redundancy,
of course,
resiliency, no outages, that sort of thing. The things that your liquidity provider helps you avoid, and also the facility, having the credibility and the trust that that when you need to hedge, that facility is there for you.
Right. I think those are very, very important points, because just exactly like you said, I've heard this too. Brokers got burned. I would say, right? At the end of the day, I've heard stories where it's like, okay, you pick up the phone, you call your LP or your prime of prime, right? And there's nobody there to pick up the phone because there's 20 other counterparties that are trying to do exactly the same. And at the same time, like you mentioned, infrastructure, I think is, again, this is all coming to light now because of these huge spikes in volatility, huge order demand, right? And ultimately, it's shown all of us that resiliency is very, 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 very important. Go ahead.
Yeah, no, it's just sort of touched on many conversations I had around the expo this week. It's people asking, in the period of January, what did you do? How did you react? And for us, like we were actually really well positioned our risk and credit models were already positioned for stress events. So for how we reacted, we didn't have to go and change conditions. Where our focus was in January was actually helping those firms that thought they had facilities scramble to try to either re-engage a relationship or really quickly find a new relationship. So yeah, I think for that point, for us, it wasn't about the reaction. It was about helping clients that maybe hadn't appreciated or weren't as prepared as they thought they were.
And this kind of brings me to my next question, but I feel like maybe we already answered it. When volatility spikes, and it has spiked numerous times.
And will continue.
And will continue probably, given what's going on in the world, right? When it does continue to spike, or in these last instances that we speak about, where do firms still fail operationally today? Is it kind of what we've already discussed, or are you also hearing things or from prospective clients coming to you and saying, well, look, when this happened in January and last year, et cetera, Trump tariffs, even going back to that, what has failed operationally besides what we've already spoken about today?
Yeah, I think operational readiness, many dealing desks are they're experts in the internalization, the beat booking, the client profiling. That is their strength, and they didn't fail in that at all. I think many brokers perhaps weren't monitoring or didn't detect the early warning signs for the one directional market. And so that's probably something they need to focus on, the operational readiness. So even if you have a strong facility to do the hedges and you know when you want to hedge, making sure, like, little things that you might not think of, are your finance teams around and ready to fund the facilities? How long will it take you to get those facilities funded? If you have a bit of a funding gap either between digital currency and fiat currency, making sure the timing of those, because the end of January showed that it's not just, you need to have facilities ready within a matter of hours. You can't just sort of go, oh, I'll send you money on Friday, hope it's there on Monday.
Sure.
Many people scrambling over weekends in January. So operational playbook, making sure that you have something that you can just reach to, and all the teams. It's not just the dealing desk, it's the management team making the decisions, the risk teams, of course, the finance teams, making sure that everyone is aligned so that you can act very quickly and move really quickly through those events. Is probably one of the things.
Do you think that some trading firms still underestimate how much poor execution intelligence quietly costs them in these volatile market conditions?
Absolutely. And so metrics that not many desks are tracking, or some are just starting to track now, are things like midpoints. So it's not just about the bid and ask spread, it's where is the mid between that, the center of the market. How does your provider's midpoint compare to the general market, right? Because you might be getting a very tight feed from a provider, but if the midpoint is skewed 20 cents away, and from your position of the book, and that might not be the same for all of their clients. Right? The liquidity provider might be skewed one direction. Half of their clients, that might be fantastic and give them a lot of compression on their execution costs. If your book's on the other side of that, that's now an extra 20 cents cost that you don't realize because the spread is very tight. So tracking the midpoint is one thing. Tracking rejects, I think the rejects is probably the metric that is underappreciated the most. Still, I think so. There's rejections in the sense of, like, a single tag was rejected, or if a tag is, like, being blocked at a level unintentionally, like the same tag is constantly rejected. But it might only be one rejection on an order and then it's filled on the second attempt. But if you look at the statistics overall, and rejection rates are, like, really anything more than 5%, even that could be argued that it's quite high in our space. That cost of reject, so you might get the first rejection, the second order is filled within a few milliseconds, but how has the market moved in that time?
True.
And we know out there's a lot of liquidity providers. It's an old trick from the banking days that is with the last look. It's, can I reject this order and then fill it again at a better price that's more favorable? And the banks all stepped away from that after sort of controversy and the criticism around that. And they got around that just by pushing out quotes faster. But for the retail world, where a lot of feeds are throttled, and the retail brokers might, they might think, oh, the second order was only filled 10, 15 milliseconds later. That might not seem detrimental. But I think if you analyze that over a period of time, especially if it's your hedges or your book that it's getting rejected, the cost of rejects can actually add up.
Yeah, that makes total sense. You bring up an old school topic of last look. Oh my God, I remember that debate. That was several years ago. And that was a really big debate, I remember, amongst everyone. Tier 1 banks, LPs, prime of primes, everybody was like, is it fair? Is it not fair? My personal opinion, if anybody cares, it was not fair. I mean, come on, that's.
No.
Oh, no, I can make a little bit more money off of you.
Yeah.
Okay, I'm just going to wait a little bit. Oh, there we go.
Yeah.
Told you.
And it's one thing, it's a metric that's not commonly tracked in the retail platforms, the bridges. The bridges are offering fantastic analytics, and I'm a big supporter of the transparency that they're giving to retail brokers. I think that's a fantastic shift, and maybe we touch on that in a little bit. But I think the cost of rejects is something we know there's a big player in the market that we're often competing against, and their execution or their spreads might seem better, but once you actually factor in that they're only filling 70% of the orders, the hidden cost can be a lot higher.
So Liam, you work with hedge funds, you work with market makers, you work with broker dealers and retail broker hedging desks. Which one of these client segments is becoming the most demanding in the current environment that we're in?
There is no shift in the theme of which one it is. It is by far and away broker dealers, retail broker dealers. They are and will continue to be the most demanding.
I see.
But that is not a problem. That is why firms like us exist. We are there to bridge the gap between their retail needs. They are experts in their fields, facing and satisfying retail clients. And firms like ours exist to bridge the gap between the retail expectations and the institutional world, the interbank market. And often, even on metrics on something as popular as spreads, the disconnect between those two worlds is very great. You know, the prices that retail clients get through retail brokers is nowhere near what you can go and execute on the CME. Gold obviously is the main product. You know, CME futures I don't think very often goes below 20 cents at the top of the book.
Okay.
Gold, if you're 20 cents to the retail world, you're not getting any business, right? So bridging that gap can be operationally heavy. It's not just the spread, it's also the terminology, it's the mechanics behind it. You know, at the end of the day, an FX trade is value dated, and if you don't do something to keep that position rolling forward, it will settle and your exposure will be gone. So operationally, they're definitely the most demanding, but it's also the most rewarding, and there is a lot of value there. So definitely broker dealers.
I guess they keep the industry alive. How much more sophisticated have retail broker hedging operations actually become over the last, let's say, 5 years? I'm actually thinking of a discussion that I had with Drew Niv, someone you know, I think, quite well as well. And I think you heard that discussion where Mr. Niv was saying, you know, we have to look at routing logic, liquidity management as something very, very important. And it seems to me like if you want to excel as a retail brokerage, you have to really start taking a look at all of these different things, because the amount of different flow that you're getting, even if it's one-sided, with respect to, you know, we have this phrase toxic flow, which has been a buzzword, I would say, this week as well, right? It seems like that's a problem for retail brokers. And so routing logic, liquidity management, and execution quality is something that's becoming more and more important. How sophisticated are retail brokers becoming or have become over the last 5 years? You know, and what are they doing today?
Yeah, the sophistication, the top end of sophistication is growing rapidly and advancing day by day. I think there is still a long tail of sophistication with all of these new emerging brokers. I think there's a lot of learning that many can do and many are doing. But we sort of service a whole array of brokers, but if we look at the top end of the larger institutions or the institutions that have been around for a bit longer, they are getting very sophisticated. You know, something as simple, well, something that seems as common now as markouts or yield curve. I remember it wasn't too long ago before no one would really know what that was in the retail world, or if they knew what it was, they wouldn't understand why, you know, why that matters. So we're seeing bigger firms, bigger brokers now tracking all of that. And that is, again, thanks to the bridge platforms, their technology providers, making that so easily accessible for firms. And at 26, we think that that's a fantastic thing. We are all about transparency. We always have been from the start. There is this shift sort of 2 years ago where people wanted to just have a single feed to handle all different types of flow. And we support that, and that is fine. But there's still the execution management of different liquidity pools behind the scenes.
Sure.
And that's where what you spoke about with the panel the other day. I really support that idea. You know, I mean, it's the transparency with the broker to match the different flow profiles that might all be coming down a single feed, and that is fine, but executing them on appropriate pools. And this is where we really see ourselves as a standout or differentiate ourselves. It's the execution on pools might be different, and it's all about sustainability. You know, it's about, there is a price for all feeds or for all type of flow.
Yeah.
You said toxicity is a scary word, and retail brokers don't want that, but they can also decide to A-book that, and they can still earn their commission revenue from that. And we're not scared by toxicity. We are very happy to receive toxic and sharp flow all day. It's just going to get a price that is justified and sustainable for it.
Okay. Yeah, that makes sense. That makes sense. Of course. I guess I could say that, and I think you'll agree, a lot of firms offer very similar access to liquidity in markets today. What does 26 Degrees genuinely believe they do different to help clients make smarter execution and risk decisions?
Definitely how we differentiate ourselves is in transparency and credibility. And that can seem, their words thrown around quite easily, but we really do believe that at 26. We work with our broker clients to be transparent. We'll tell them where their flow is getting executed, how it's getting executed, what are the flow profile, what are the spreads that are justified for that flow profile. And we don't want to, if we receive sharp flow, it might not be outright abusive. If we receive sharp flow, we don't want that flow to get a poor execution and then disappear. You know what I mean? We want repeat business. We want to have sustainable execution to sort of pound that point. So for us, and how we differentiate, it's the transparency behind that. We're not trying to rip every dollar of yield that's possible out of the flow. We want repeat business. So part of that is handling the flow profiles. But if you're not keeping the retail broker in the loop, so their dealing desk understands what's happening, then that's just going to be problematic. It's going to cause complaints for your client's client, or for your client, and it's going to fill up their support inboxes, and they're not going to like that, their liquidity provider. So that's the transparency side, and we're firm believers of that. And then the credibility side comes back to the sound risk and credit management. You know, and we at 26 have said for a long time, and we stand by it, we don't like to compete on risk conditions. You have to be competitive, or you have to stay up to date with the market if you want to be in the market. But we are not going to undercut ourselves of the views or the risk profile that we see that is inherent in gold just to win a deal. And I think that method, or that thesis, was really proven. We proved that to ourselves in the events of January, and we have been riding the waves since then. Clients are now, retail brokers are now starting to become more aware of that, especially as they might have been, used to quote you, burnt in the January events, right? Either through hedging at the not soon enough, or when they went to hedge, the facility wasn't there. So that's what comes back to credibility. When we issue an allocation, our clients can trust that we're a strong counterparty. They know that facility is there. It's not going anywhere. You know, throughout January, we didn't have to pull back on any limits. And I think that speaks to the risk model that we have and will continue to operate.
Yeah, absolutely. And I think I wanted to ask you, when again, when you were talking about transparency and kind of, okay, we could receive, correct me if I'm wrong, like let's say toxic, abusive flow, that's fine. We just have to manage and treat it accordingly. When we talk about communicating with the retail broker about that, is that just simply picking up the phone and calling their risk desk and saying, hey guys, listen, we just saw this, we just saw that, just want to let you know, like we're taking this, but it's going to be X, Y, and Z, and we just want to let you know. Is that how this takes place? Or is it, I don't know.
Yeah, phone calls maybe are
phone calls
dying these days, and as in more instant messaging, you know, Slack and Teams chats. But that's that communication. It's simply that. We welcome those questions from our broker clients all the time. We're very happy to talk to our trading team and get them some feedback, which can help them manage their book, you know. And that is something that our clients come to us all the time, you know, and they'll hit up the desk on the instant messenger and ask, oh, how are you seeing this tag? They might have suspicions that they can't prove necessarily, or just an idea that they want to validate. So they'll come to us and they'll see what we're seeing. Are we seeing correlated flow between brokers? You know, sitting one layer up there, we have a bit of a wider view of the A-book feeds, that is. So it is just communication simply like that. And it's, all done through Messenger these days. There probably should be more phone calls, I think.
No, I didn't mean it that way. I'm just kind of like, I'm just, you know, as a layperson, I'm like, how does this actually happen?
Yeah, you're right. Yeah, just picking up the phone, talking to them. These tags, making sure that they're happy with the executions they're getting. And for us, we are happy with toxic flow. If it's outright abusive, then the retail broker probably doesn't want to entertain that. And if it's abusive and they get a fill that is fair for that abuse, that client will stop trading because their abusing strategy
of course
is going right. So we're not in the business of facilitating abusive flow.
Sure.
Toxic flow, I think, is can be used interchangeably. Sharp flow, I should say. Sharp flow, we are very happy to support sharp flow, but we will do so on a price that is sustainable. And we don't want brokers just shopping around sharp flow. I mean, there'll be another one of these other sort of new prime of primes that'll be offering a tight price. It might be good for a week, might be good for 2 weeks, but I mean, you can't monetize sharp flow long term. So for us, it's not about a quick buck or trying to hold on to something to win a deal. It's about, can I sustain this for a long time?
Sure. I like how you phrased it, sharp flow. Another colleague of ours in the industry, Alexis Drasiotis, I think he labeled it as unwanted flow, right? A couple of days ago.
Yeah.
I like sharp more because it's in between toxic and unwanted. Sharp, it's good, it's sharp, and you're like, okay, I got to do something with that. Got to do something with that.
And I was listening to a panel a couple of days ago, and there was a really interesting point by a senior dealer at one of the really big retail shops, and he was saying that flow from a particular country, a particular region, can very quickly be labeled as toxic, right? And I think a lot of brokers will see IP addresses in this country. Everyone knows what I'm talking about. And they will immediately assume that it's bad or that it's sharp. But this gentleman was saying that, their edge there is that sharp flow, if you're too quick to judge it and kick it off, then that'll actually create a bit of a bias in your reputation, and you will turn away potentially a lot of good flow. Like this country that I'm talking about has a huge amount of population, much flow that is not necessarily educated, and people that are not trying to take abuse. And I think the brokers that are too quick to profile that and try to kick it off are actually missing out on a lot of valuable flow.
And just like Drew Niv said, and again, we just talked about routing logic, you can probably take a lot of sharp flow and put it to good use. You can maybe even generate some revenue from it if you know what you're doing, right?
Yes, exactly. Yeah. And it's not like we can also monetize sharper flow than perhaps a retail broker can, because where we sit one layer up, 2 different sharp profiles might be able to net off. And so for us, we do encourage brokers to if there's flow that is not abusive but is sharp and they're looking for a home for it, we do encourage that conversation. We're very keen to have that conversation, but it's all about just that transparency, picking up the phone, going, this is the spread that it's going to get. And this is why it's justified and why it's fair. And if that's done correctly, then that flow can be sustained.
And it's interesting that you mentioned yield curves, because I agree with you. That's not something that really a lot of retail brokers looked at years ago. But as we were actually taking a ride down here to the studio today, I told you about a different business that I manage. And in that business, yield curves and this type of information has actually become quite commonplace to identify abusive traders. You know what I mean? Because again, when you sharp flow, obviously today's discussion is very much so institutional, but when you look at the actual retail traders themselves and how brokers are, again, looking at their book and seeing what's going on, yield curve is actually something that even comes up on the retail side when you're trying to assess a client's trading and see whether let's say how genuine it was, in a sense.
Yeah.
Which I guess maybe is surprising to me, because it feels like this kind of information was always available to us, right?
Yeah.
It just wasn't necessarily utilized years ago as it is today.
Yeah, I think utilization is one thing. You're definitely right there. It's also the ability to process that data. Yield curves at the scale of flow, producing yield curves and calculating yield curves, whilst a simple calculation, producing that data in real time at the scale of where the industry is at these days is very hard. And it's funny, you make me think back to when I first joined the dealing desk 9 years ago. I remember we had a Excel macro that could calculate yield curves, but we could do so for, I think at the time it was a maximum of maybe 5,000 rows. And it took about 15 minutes to process 30 seconds of yield curves. So back then you couldn't use yield curves every day for all your flow, but thanks to the technology advancements, you can get that in real time. And it does make sense to be evidence of whether flow is being abusive. Like now, if we're not talking about sharp, we're talking about that flow that is outright abusive. If you have a tag that is constantly on the right side of trades and not just lucky, but systematically picking a price that the market immediately moves against them, and I say like within a few hundred milliseconds, that feed is clearly informed and clearly trying to take advantage. And that's the flow that yield curve is fantastic to identify and to justify removing, because that is flow that is, I think, in my opinion, bad for the industry. And I think brokers trying to sustain that are only perpetuating the problem.
That's a great point. I guess looking into the future, let's say 5 years from now, do you think that firms, and again, I can't believe that firms would 5 years from now still be trying to compete just on liquidity access and tight spreads.
Mm.
But let's say they do. Are they going to become irrelevant as compared to brokers who, again, are looking at automation, execution intelligence that we discussed today, and then real-time risk visibility, just like what you said with yield curves and how fast technology is progressing within our industry, and also automation?
Yeah. No, I think firms, if they are still competing in that space, only on those topics, or that area of tight spreads and nothing else, no intelligence behind it, I don't think they will survive. And to be honest, my view is that I think we'll have a few volatility events that within the next 5 years that probably take a lot of that out of the game and is healthy for the industry. But to your point, if they're only competing on that in the future, then they're not going to be able to survive. Retail brokers are getting more and more advanced by the day. Technology getting more advanced, as you said. And the events of January and the events that we will continue to see show that you can't just run a B-book only model where you internalize everything, hold on. You know what I mean? At the end of the day, even the biggest companies will struggle to have a balance sheet big enough to sustain that. And I think January showed that and proved that for many of the biggest firms. So the firms that will survive and come out on top are those that have the technology to pick up on the early warning signals, have strong relationships with their liquidity providers, getting tight pricing, but also getting access to early warning signs and triggers where they can start layering hedges early on. So the B-book model or an internalization is, of course, still around. It's, of course, how this industry makes its money, and it will continue to be that way. But it's very much a hybrid model is needed. And for the volatility events, and hybrid models need the support of intelligence and intelligent systems, intelligent dealers themselves. They'll always be the human element, so in combination.
It seems to me like, again, if there are firms that are still going to be out there 5 years from now that, again, are only competing on price and access, they're just going to be leaking tons of revenue.
Yeah.
Some companies, I guess, are okay with that, but at the end of the day, I mean, why?
Yeah. My view is that the yields in this business, in the B2B business, if you're not keeping up with the intelligence that's expected and the requirements of the retail broker market, I think the yields will get too lean where the UBOs and the shareholders just won't want to support that anymore. I'd say to all the new prime of prime entrants and the new B2B entrants is you need to advance your systems and adapt, because if you're just offering a price feed, your business is going to dry up pretty quickly.
Yeah, that makes total sense. Absolutely. Well, Liam, thanks for a quick, informative, and very insightful discussion. It's been a long week. I'm sure you're looking forward to some rest in Greece.
Yes.
I'm looking forward to some rest here locally in Cyprus. But it's always a pleasure to see you. It's always a pleasure to get your insights, and kudos to you. And I want to say hello to the rest of the 26 Degrees team, James Alexander, and everyone else. Wish you the best of luck. See you soon.
Thank you, Nikolai.
Thank you. Cheers.